Not all investments are created equal. In fact, the difference between a winning deal and a very costly mistake generally comes down to one thing. And having the right go or no go standards can make all the difference in the world. Today, we're going to talk about the 10 must-haves that we have on Faris Capital to make sure that we don't make a mistake when we're buying a property. By having a standard to filter your decisions through, it saves you a lot of time and potential heartache as well. John, great to be here with you.
Yeah, Mark, really excited on this one. That decision-making framework is so critical. Yeah. And, it's an area where, especially when I'm talking to young entrepreneurs, I see they're sometimes lacking that, right? And so one of our core values at Faris Capital Partners is to make wise choices. And the best way to do that is to build out frameworks for everything we do on a daily basis, a weekly basis, a monthly basis, to help us make sure we're making those wise decisions. And so looking forward to diving into this topic. We just closed on a new deal, and we're seeing the results of that framework in action. In other words, we're already projecting rents $50 above our pro forma just because of some of those decisions we made, 6 months ago when we were first analyzing this deal. So it's a really great topic, and I'm excited to dive in with you today.
Yeah, we got a few days into this new deal, so we're right into the 28-day full-out transformation there on the property. So how's that going so far, John? How are we starting off?
It's my favorite kind of time when we close a deal, and I'm not joking, within an hour of closing, the road construction crews were there fixing the parking lot, right? There was some areas where I think a garbage truck had caused some damage near the dumpster. It was just unsightly. We're actually already into painting. The two units that were vacant are under renovation. So within just a few days, we attacked the property. And how we handle that with the residents, as you know, is we go out and we don't just drop a letter on their front door. We knock on the doors, we introduce ourselves, we apologize for some of the disruption they'll experience, right? We try to minimize that, but it's all in an effort to beautify and make their home a better living situation. And as you know, our mission at Faris Residences, our sort of resident side of Faris Capital, is to go full out and provide that best living experience in the world. So, in about 20 more days, they're going to see the fruits of that hard work and just be so excited for, where they live. And so that's, for me, the most exciting time in our business when we close that deal and just seeing the crews pull their trucks up, like I said, within an hour. I mean, no joke, of closing, right?
Yeah. And this is where, unless you're very intentional to be able to get all this work done within 28 days, it becomes one of those never-ending project things, right? You start doing one thing and then you get to another, 6 months goes on, 1 year goes on. But the challenge with going that other approach is the fact that residents, they see that things just never get done. And with that, they grow a little bit more, we'll just say, lax in regards to how they treat the property, and they're not feeling that love. But because we go in within 28 days, it's just like bam. It really shocks them in a good way to let them know, wow, these guys mean business. And when they say something, they do something. And so it changes the community culture in a real way. And so this is where, same with me, when we close on a project, just seeing it unfold and the type of organization and preparation that we put into it is really important. And so this is where what we're going to be sharing with you is one aspect of allowing us to move quickly. And so we have hundreds of deals coming through on an ongoing basis. And so our full-time acquisition specialist, Joe, is constantly out there every day. And I know, John, you're actively out there as well. And so, John, maybe you can share some insights on the types of properties that are coming through and why do we need a standard to be able to do preliminary filtering before we go in and deep dive and do all this underwriting, because you just don't have the time to do full underwriting and spend hours and hours on, all these properties. You just don't have time to do it. So maybe you could share some context there of the types of properties and, what our process is there at the beginning.
Yeah, and that's just it. It's time, right? And it's the one thing they don't make more of. And so you have to be very thoughtful before you even dig in. And so at Faris Capital Partners, we specialize in value add investments. So what we're looking for are, slightly aged assets, we're not talking about brand new construction deals. We're not talking about redevelopment opportunities. We're just talking about properties that need some TLC and need better management and operations. That's where we found the best balance of risk and reward. And we minimize the risk through having things like the 28-day transformation we just talked about. An example comes to mind that Georgia Patrone, our senior VP of asset management, shared with us a while back. She was at another operator. And what was happening is they took it over and the market was just experiencing some incredible tailwinds. And so they were able to achieve their rental rates that they had thought, would need renovations to achieve. And they were getting it without doing any work. And so what happened is they just coasted off of that. And then about a year or so later, a wave of new supply came online and it started eating into the rents, and organic rent growth actually went negative. And they found themselves in a situation where they actually didn't have the capital to complete the repairs they had initially wanted to do. And it turned what could have been a really great investment that would have actually been really well positioned to compete with those new assets into a, kind of a loser. And so, it goes back to that framework. Like, we know going in, we have a plan. Now, it's not to say sometimes we might not deviate a little bit from the plan if new information emerges, but you built the plan, you believed in the plan, and the next step is to execute. And Mark, we've even seen assets where 3 years later, the operator still hasn't done the landscaping, right? And these are things that you might say, well, landscaping, it's no different than a buyer, right? A buyer who's thinking about buying a home, it's curb appeal. It's the first thing they see, right? So when somebody pulls in and there's a dead palm tree behind the sign, they're going to go, what else are they not taking care of, or what else are they neglecting? So those value add deals are what we're looking for. So what happens is we get a lot of new deals, and right now in the marketplace, the majority of new deals being marketed to the public, so the deals that the brokers are just blasting out to their database, tend to be newer deals, so deals that were built within the past year or two, or they're like 60s and 70s vintage. And that is our number one, kind of criteria. It has to be 19 or 80s or newer. And a lot of that is driven by, down here in the United States, building codes were sort of like very like loose to non-existent prior to 1980. So things like lead-based paint, which a lot of folks are aware of, that was banned in 1978 in the United States. You had polybutylene plumbing, problematic electrical systems. And so by getting into the 1980s or newer, a couple of things. We have less of that problematic building material that could impact the quality of the building and its long-term value. But you also started to see a shift in things like the floor plans, right? And so really recently, some survey data came out and it was talking about the top things that residents are looking for in their rentals. And the number one thing was walk-in closets, just having more closet space. And pre-1980s, you typically saw like, the kind of accordion door, just with like a couple, one little row that you can hang
the doors
your
kept
stuff on.
popping off on those. I remember you'd be going in and it's like, oh, we got to fix the door, and it keeps popping off, right? I remember
exactly right.
And that's a very common thing, right? So for sure.
So just those 1980s or newer, really it comes down to the building and construction quality, but it's also a floor plan consideration. And given the fact that there is new supply coming online, it's important that we have floor plans that meet, our residents' needs.
Yeah. So that's the very first qualifier of the 10 that we look at. And so just before we go on to the next one, it's very important to know when you have this kind of deal flow coming through, you got to look through 200. You need to be able to look at all of them and have a consistent decision-making filter. Okay. Because nothing scales like process. Nothing scales like systems, right? And so when you have a process for making decisions, you get more right decisions, right? And so by not buying anything in the 1970s, that keeps us away for any of those potential pitfalls. So 1980 or newer, that's the first, we'll say, checkbox that a property needs to hit. Now, you may say, what happens if it's a crazy deal in 1970? Then we would need to really talk on that, but that's going against what that first filter is. Like the case would need to be so strong for us where it'd be, okay, this is going to be a quick flip when we've done some deep due diligence on that, but that is more the exception rather than the rule. Yeah. And so the reality is when you have, hundreds of properties coming through, you need to be able to go through each of them in a methodical way to be able to get the cream rising to the top, so then you can spend majority of your time on the best deals. Okay. That's right. So 1980 or newer, that's the first one. The next component is where John and I, we get really excited is the value add component. So when we go in and see a property, we want to be able to ensure that we can come in and add value. We don't want to just have a turnkey operation where we just come in and, just watch it continue to operate. We want to come in and add value, because that's how we're going to get next level returns for our investors. You can go in and buy an asset and, get say 10 to 12% returns and really not do anything. But for us and our investors, we want to be able to add value to the property and get higher returns, the 20% annual returns. And so it takes more work to do that, but that's one of our differentiating factors. So that's the second, is the value add component.
And yeah, to go further there, you might find a great asset that was built in the 90s that meets that kind of first criteria, but maybe the current owner has already renovated all the units. So it's lacking that value add component, right? So it's our ability to come in and put the Faris stamp on it, right? The designers we work with, the quality of the construction and the materials, but also the execution we bring. So without that, it actually eliminates that first one, right? So that value add component is huge for us.
Yeah. And in some cases, we get it, like John, this most recent deal we were looking at is 240 units. And the reality is all we're going to do for value add is do some exterior work, and we're going to leave it. All the interiors, there's 100 units that are renovated and the rest of them are not. But the business plan on this was to buy it at such a low cost basis. We're just going to hold it, and we're going to improve the operational excellence side. So the value add is some minor exterior work, but it's in the operational side to ensure that we're getting higher reviews, we're treating our residents better. And just by doing that, there's going to be enough of a return, and it'll be a quicker flip. It'll be a 2 to 3 year hold, but doesn't necessarily mean we're going to come in and do a big overhaul.
Yeah, that's right. That value add can come in many forms. In this case, it was a pre-foreclosure opportunity, and the current operator, kind of in a sense of stress and panic, started, leasing units at a good headline rate, but giving away months of free rent, right? So those concessions, so you look down the P&L statement a little bit, and it's like, oh, great, they're getting a good rent here, but oh gosh, what's this? It's concessions. And so you burn those concessions off. So that's a great example of another sort of value add approach to these deals. It's not always in those renovations. So strong point there. Right
on. The next stage here, so it's 1980 or newer, it's got to have a value add component. And then the third element that we look for, or a checkbox that we filter all of our properties through, is it's got to be able to return 5% cash flow distributions for our investors. This is something that our investors, having that incoming, we'll call it mailbox money, is something that's really important. And so for us, what we generally do is between 3 and 4 months, after we close on a property, we'll actually start those distributions, but we'll do a catch up from closing. So that very first check that we send our investors, or the direct deposit into their account, that comes in, and that's a larger first distribution, and then it's monthly after that. And so that's all return of capital. So it's very efficient when it comes to tax purposes. But having that ongoing cash flow is really great, because we'll call that the appetizer for the investment, where the majority of the returns come after we renovate and sell it in 3 to 5 years. But that ongoing drip, that mailbox money, is something that a lot of our investors really appreciate.
Yeah, and I think it's also critical to think about those cash distributions, right? Like, yes, it's the mailbox money, that's exciting. But what it's really suggesting is that this deal is already profitable, right?
Yeah.
Because that cash flow is your net operating income minus your mortgage and taxes. So it's a real true picture of the financial stability of the deal. Now, there are awesome opportunities that you can take down where you might actually lose a little bit in year one, and then you can kind of make up in year 2 and 3. And then, it's kind of the more opportunistic play. But we just don't like that, because the risk is higher there. And it goes back to the value add, which balances that risk reward in a way that is very attractive to us. So that cash flow metric is important for a variety of reasons, but to me the most important, it's just the deal's already profitable. And so with our operations and our approach, we can increase that over time, which is, like you said, this is just the appetizer. The meal comes at the end when we exit. But it's one of those things that an investor should be thinking about. And if the deal is not cash flowing in year one, you need to ask a lot of questions and really understand the forward-looking business plan.
Yeah, well said. The next element that we filter our decision through is 15% annual return. So this is something that we ideally want to have 20%, but unless it's 15% or higher, we just won't look at it. Or if we do look deeper, we're trying to get very creative on how we can actually drive those returns higher. In a lot of cases, we need to find something that other investors, other operators are not seeing. And so just finding things that other people don't see and finding value add opportunity is a big part of driving those 15% plus annual returns. But that is a key metric that we don't want to go to market with a property that is below 15%. And ideally, we want to be closer to 20.
That's right. And I think the way we think about that is, historically the S&P 500 in the United States has delivered approximately 9.8% annual return. So you might have a bad year, good year, better year, but it balances out to an average of 9.8%. So for us, we need to have an investment that's going to deliver significantly more returns than somebody could get just putting their money in some sort of an index fund. And you said it's really 20% is what we target. But when we do a back of the envelope underwriting, by that I mean just that first glance, we put the numbers in, we look at the rent roll, which is a accounting of every single lease, every single deposit, and just shows an overall health of the leases at the building. And then you have the financial statement. And so we can quickly underwrite that without going deeper. And if it's not hitting 15, then it's just like, we're not even going to continue down the path with this deal. Because to your point, it's really about finding those opportunities within the deal that others have missed and getting it to that 20. So that initial underwriting is super important. So we don't waste time on a deal that isn't going to be a great fit, and we miss an opportunity because we were over here spending time when we should have been looking at this other deal.
Yeah, right on. And just so you're aware, when we filter a property through this, then at the next stage, we have like a 25-page proprietary underwriting model that we go deep and we do deep underwriting on these properties, and we do deep analysis on multiple different sites, but we go we'll say more detailed oriented. So this is just a preliminary high level criteria before we take the next step. And so the next stage is low crime. And this is the filter that's really important because we want our property managers that are on site to feel safe. And I know Georgia shared this this is one of the things we were looking at an asset, and it was in an area that wasn't super safe. And, I remember Georgia sharing the story of, some of her past experiences in areas that just, you don't want to get a phone call saying that your property manager was, we'll just say there was a negative experience there based on the area that you're buying the building from, right?
That's right. I mean, just for our people, right? That's huge.
Yeah.
We want to make sure, and our residents, obviously as well. But, crime has a major impact, right? So for us, we go to spotcrime.com. We have a couple other websites we look at, and you can literally just map out the area. And so you go to the best area in the United States, you're going to find something, right? Whether it's DUIs or, sometimes petty theft, no areas are immune from that. So we're not talking about zero crime, but what we are avoiding is any sort of assault that is non-domestic related. So, muggings, gun violence, etc. If gun violence shows up on our spot crime map, it's an immediate kill. We just don't even look at it. And the reality is
not
that,
literally, right, John? Not literally.
Not literally, but yeah, we hard delete that from our that one's gone. But it comes back to people in the community don't forget those types of things, and I can tell you, if gun violence happens at your property for 20 years, people remember that. And so even in that surrounding area, there was a deal we were looking at actually in Savannah, Georgia, which a great area that has a lot of opportunity, but when we pulled up crime, it just, we stopped talking, there was too much, and it just didn't feel like a kind of area that we wouldn't want to send, and this will come back to the 10th, which we'll get to, but it just wasn't an area that we would be proud of or we want our children or grandchildren to live in, right? And so that's one of our criteria that we'll get to here in a minute. But crime's super important. And I would add to that, we're also looking at the schools as well, right? Because there's a relationship there. Now, it is important. It's not as important only because sometimes school is less of a factor. Maybe it's in an area that has more retirees. So we look at the schools and it's a part of our decision-making criteria. But I'd say crime is the first because that tells the story. Usually high crime area is going to have bad schools. Low crime area is going to have good schools. Not always, but that's generally a relationship you can count gone on.
Yeah, right on. The next filter we look at is increasing population. We want more people moving to an area, which means that those people need a bed to sleep on, right? And they need apartments. And so when you're buying in an area where there's incoming people, it's like having a growing customer base. It only makes sense. So, when the automotive industry went overseas, we saw what happened in real estate. And there are a lot of people moving out because jobs moved out, right? And so this is something that we want people moving into an area. So jobs are part of it, which is the next point. But with increasing population, jobs are part of it. We also look at, so weather is a part of it. Low taxes is a part of why people move into an area. And a big one is affordability. So we like buying in areas, and this is, if we're looking in an area, we know the population is growing there. So that's one of the main check boxes. But if we're buying in a specific area, we know that there's going to be more tenants coming in, more residents coming into the area, which is going to just set us up for success, that we have the current at our back instead of we're swimming against the current.
Yeah, and to be very clear there, we're not, say, for example, if we're investing in Largo, Florida, which is a submarket of Tampa, we're not looking at Tampa's population growth. We do factor that in, but what we're looking at is the 1 and 3 and 5 mile radius around the asset. And so I think a really great example of that is if you look at Goose Creek and Moncks Corner, we have an asset in both of those markets. And in fact, our newest acquisition is in the Goose Creek submarket as well. Within a 1 mile radius of Faris residences, Goose Creek, in the next 5 years, the population is projected to increase by 14%. In Moncks Corner, within a 1 mile radius, 17%. And you go 3 miles out and you can see it's the whole area. And so even if you see new inventory coming, there's 500 more units, we factor that in. But when you see that population growth, you've got a winner on your hands, because, ultimately that kind of population growth, it's going to result in those markets, the average person, 41% of the people rent. And so, big renter base, low cost of living, high population growth, that's a big yes for us.
Yeah. And you could just drive down the road and you can see what's happening. I mean, there's a Home Depot that's going in there. You have new development coming in. You have the Starbucks that just went up. Like that is a telltale sign that, these retail shops, they do, like Starbucks, McDonald's, these guys are experts at knowing where's the growth areas and where are they putting their stores. And if you can get close, like Moncks Corner is like right across the street, there's like a Walmart right there. And, the reality is, first, that's our demographic, because we do a lot of workforce housing. So this is the working class, right? But the reality is that these guys, they do enough analysis to be able to say, yes, we're going to put a retail store there. And so you can see it just driving down the street that the population is actually growing in that area.
And that's such an important point, because we do drive the area. We don't just drive from the airport to the asset and back to the airport. We spend a lot of time just driving around. Now, part of that, we also look at every rent comp. But while you're doing that and you see that development, gosh, Mark, there was a period of time, it's not so much the case these days. It's probably Chick-fil-A is actually, but you call it like the McDonald's index. And other real estate developers would just look to see where's McDonald's building new, McDonald's stores, and let's go buy land around there, because they're a real estate company, right? If you know McDonald's economic model, they are a real estate business that just happens to have hamburgers on the menu. They're a real estate play all day long. And so they have satellite imagery, like they know where it's coming. So if they build I would say today it's that Chick-fil-A Starbucks index, right? You see a Chick-fil-A being built nearby, you're like, okay, like this is a high growth area. Now, we verify it with data to be clear, but those are clues you can look for when you're analyzing a deal, just to back up what you've already kind of thought, right? The population is growing. So that's a great example.
By the way, if you haven't seen it yet, you have to go watch The Founder. John, have you seen that movie yet?
I love it. Yeah, I've watched it a few times, actually. Yeah, it's such an interesting story.
It is a fantastic story. And obviously you're listening to us, you like real estate, right? And that there's a couple parts in there that always get me. The system side of it.
Yep.
And then the other part of it was like when he figured out that he was in the real estate business, as you referred to.
Yeah.
But just so we're clear here, guys, at this point, we're just looking online. So this is a preliminary look. So increasing population is something that we can go online and find this out. So CoStar is one of our platforms that we spend tens of thousands of dollars on every year to get access to this proprietary data. This is something that tells us very, very clearly where population trends are happening. And then there's multiple other sites that we go on as well. So we have population growth. And then the next one is strong, diverse, I'm going to underline diverse employment in the local area. John, maybe you could talk a little bit about, the importance of diverse employment, and then where would we get that type of data to be able to make a decision if this opportunity property is going to be diverse employment?
That's right. Yeah. So we have a few different sources we look at. And so just to back up, diversity, what we're talking about there is we don't want to invest in an area where one industry dominates the majority of employment. You mentioned Detroit earlier. That's such a great example where their entire economy was dependent upon the auto industry. So when Japanese cars started being introduced into the market, there was a pullback, and then manufacturing went overseas, there was a pullback. And so they've had all these boom and bust cycles because not only were they manufacturing cars, but all the suppliers, and all the, tool makers, everything was there, and it was all dependent on this one business. So we look for areas that don't have just one main economic driver. So Charleston is a market I think a lot about, where there's a strong pull from tourism, but you have military contractors there. Volvo just built a manufacturing plant. Amazon has distribution hubs there, and there's a lot of tech, a lot of young people moving there. And so some of the sites we look at, you mentioned CoStar earlier. CoStar pulls data in from a variety of sources, including census data. And so we can go in and we can look and see the area. And going back to what I mentioned earlier, 1 mile, 3 mile, 5 mile, who do these people work for? And so what we like to see specifically, because as you mentioned, we tend to do workforce housing. So nursing, police, firemen, jobs that are recession resistant. And then we go out a little bit further and we say, okay, there's manufacturing jobs here that are high paying, quality jobs. And the Volvo plant being a great example of that. We also look at census data directly. So you can go to the census, Google search U.S. Census and find data there. There's another great website I like, dataus.io. And you can literally look up by city. And so we just verify all this data from a variety of sources and pull it all together. But that economic diversity is huge. And another factor, is there are markets, for example, that are very driven by the military, right? And it's not as if we avoid those areas, but you do have to be mindful, because if there's a deployment or something like that, it could have a major impact on the investment. So it's really looking just to make sure that there's not one industry, just to say it simply, that dominates the employment in that area. So markets like Tampa, Charleston, Atlanta, that just have a variety of, another place too, Mark, I failed to mention is the business journals. So, there's an Atlanta Business Journal, a Charlotte Business Journal, Tampa Business Journal. And then we go and we look and see what is in the hopper, right? Like what just got announced, which, company may be coming in. And we've touched on red state versus blue states before, but a lot of the red states in the U.S. have strong tax incentives to bring developers in, so our new businesses in. So a great example was here in Georgia, the governor just negotiated a large contract with Rivian. So Rivian builds a huge assembly plant here, and then that brings a lot of new jobs, not only for Rivian, but all the people that supply to Rivian. So you want to make sure that the state or the municipality you're investing in is business friendly and is looking to attract new business coming in. And I say that because there are areas, believe it or not, Mark, that don't want new business. There's a suburb not far from where I live where they don't want the business. They want to be a bedroom community, and they actively push that stuff away. But the problem is that becomes a burden on the homeowners who live there because their taxes shoot through the roof. So business friendly is huge.
Yeah, you nailed it. Leadership is a big part of it. So if you have leaders, the local politician does not want growth. Like I'm not going to bet on changing them, right? I'm going to just take my money and, our investors' money, and we're just going to go, one county over, one city over type thing. And so that's a really big part, leadership as well. It's well said. So the next one is the market value of the tenant's income versus rent. So if, for example, we want to be 35% of the average income in an area that's going towards rent after we do the renovation. So for example, if the average income in an area is $100,000, the renovated rent on a annual basis needs to be $35,000 or less after we do the renovations. And if it's not, then that's probably not an area that we want to invest in.
Yeah, no, it's very critical. Affordability. At the end of the day, if people can't afford to live and pay their rent, and you said it right, it's after renovated value. In fact, we generally look for 30%. That's when you've hit a really good sweet spot. But at the end of the day, things are getting more expensive, and so we're seeing people put more money into their rent. So 35% is our after renovated value, and it just goes back to the affordability of the area, making sure you're meeting the people where they're at. Now we look at average, but we also look at median income, because sometimes what can happen is a few very high income earners can pull those numbers. So we look at the 1 mile, 3 mile, 5 mile, just to make sure our product will serve the needs of the residents already living there.
And to give you context, so Toronto's income to rent ratio is 60%. Okay, New York is 70%. And so here's the reality of the situation. If people are paying that much of their income on average towards rent, they do not have a lot of leeway or a lot of extra, we'll say, disposable income for you to raise rents on them, right? It's like they're getting squeezed so far already. It's like you can't just you can't keep squeezing when they've already been squeezed so far. Yeah. But at 30, ideally, if it's 30%, that's wonderful, because if we need to bump the rents up a little bit more, the reality is there's extra disposable income. And not only that, I'm just going to take it one step further, is when the tax rate is lower, they're not paying as much towards income taxes, which a lot of these states that we're investing in, it's like 0% or very low sales income tax. Then they have, again, more free dollars that can go towards their rent. If they really love a community and they're getting served really well, they'll pay a little extra. But if they're getting squeezed, they just won't. And so that's why we like buying in an area where they likely have extra disposable income based on numbers and percentages.
That's right. It would also go even a step further, right? More money to invest in other parts of the community, at stores and shops, which support the overall community. So, it's a huge factor for us.
Right on. The next one is something that we had been in a partnership deal, and what we saw after a couple of years was a inflow of new units coming online. And so this is something that you really want to make sure that you do your due diligence ahead of time to be able to look down the road as to where all the permits coming out, because in 2 to 3 years down the road, when those come to market, you're going to have a lot of competition. So that's something, John, that we really look at when we look into an area. It's like, okay, what's the direct competition? Not only today, but we want to know 2 to 3 years down the road as well, what's coming.
Yeah, and that's the beautiful thing here, Mark. I mean, these projects take years to from permitting stage to completion. So it's not some mystery, right? That you can go to the economic development, arm of the government and ask those questions. The city and the county talk about permits. We've talked about CoStar. CoStar looks at that, and you can see that projected out. And so, one of the headlines today is we have had an influx of new inventory hitting largely across the United States, driven by the pandemic and the low interest rates, but that has effectively stopped. So looking forward, in a lot of the markets that we've purchased in, that wave of new inventory will actually become a supply constraint because it won't keep up. So, going back to Goose Creek, Moncks Corner, 15 and 17% population growth, but basically no new inventory coming on starting in 26, 27, 28. And if somebody started today with the planning process, they're not getting permitted probably for 6 to 9 months. They're not going to have a delivery until 28, 29. And so knowing that, those are areas that we just love, and we're going to continue to look for opportunities there.
John, that's one of the most exciting things that I see about the future right now, is that whole story that you just said. The amount of deliveries that are coming out on the market, there hasn't been any new permits being pulled in this market. So we have 2 to 3 years runway of real upside here. And so this, to me, is, I'm very confident based on the numbers that we're coming into the bottom of the market. And so you want to be buying all through this, because based on the very, we'll say, low number of new inventory that's actually hitting the market, and based on the projected population growth, there is going to be a supply constraint out there, which is going to help drive rents, which is going to drive values, which is going to drive higher returns for investors. And now is a time that you want to buy because it's not sexy to buy right now. Right. And so the data is telling us this whole story. And that's really, John, our job is to get that story out there to our investors and say, hey guys, like here's the data, here's what it's saying. And we have charts and whatnot that, we go through with our investors as well. But this is something that is a very telling story for, a year, 2 years, 3 years down the road. It's very strong.
Absolutely. And, one of the things that's happened as well is interest rates have, persistently stayed high. And actually forward looking, I don't really see rates coming down. Now, when we say rates, we're not talking about the bank rate. The Fed rate has dropped, but the treasuries have increased. There's some concern about future inflation continuing to be an issue. And so with mortgage rates in the 6 and 7, 8% range, depending on, the time, you might be listening to this at a time where they've gone up or gone down a little bit, but the gap between the affordability of renting versus owning, it's now $1,200 more in the United States to rent than to own a similar property. And so more and more people are renting, people are buying homes later in life. And so there will be more desire and more need for rental property. But then you combine that with what we just talked about, a slowdown in new development, which is going to make investing in multifamily real estate one of the wisest choices you can make.
Yeah, for sure. Definitely. It's much cheaper. It's much less expensive to rent now based on those interest rates. So
that's right.
For sure. And so last but not least, the final qualification that we really look at is one that it seems like more of a soft point. It's not like something that you can really nail down in regards to a key metric, but it's something that's very clear to John and myself when we make the selection. And it is a property that we can be proud of. A property that when we put our monument sign, Faris Residences, on there, that we can be proud of that property. And you know what? Like some properties are just like, listen, that's just not a property that matches with Faris Residences, with our brand. And so that's actually a big one, John, that is really, it's harder to substantiate what that actually means. But, it's something that's very clear to you and I when we look at these properties.
Yeah, some of it's aesthetics, right? But how I like to think about it, and I think you actually originally sort of said something like it, but it kind of like stuck with me in this context. So I have a 20-year-old. He's in college, but it's kind of the way I think about it. Would I be okay if my son said, hey, Dad, I found a new apartment I'm going to move into? Like, would I be comfortable? And that could be safety, that could be aesthetics, that could be the functionality of the space. But I like to envision that, like, would I be comfortable letting my child live here? And if the answer is yes, then that's how I think about it. And I know some of our investors think that way, like, would I want my child or my grandchild living here? And so, like I said, sometimes that is aesthetics, but it also could be the feel of the area. And, you nailed it. That Faris name is on the sign. And so we just, at the end of the day, need to be proud to call that one of our buildings.
You nailed it. So to summarize here, guys, first point, 1980 or newer, we want to add a value add component to it. 5% of cash flow distributions or higher, 15% annual returns, low crime, increasing population, strong, diverse employment in the local area. The income to rent ratio has to be under 35%. Ideally 30% or lower, and low new units coming online in the direct area. And last but not least, a property that we can be proud of. John, any last thoughts here as we wrap this up? That's like our preliminary criteria that we filter through, and then we'll have another session as to our deep underwriting. But the reality is that that's what we go through to as an initial qualification there. So anything to add here, John, before we wrap up?
Yeah, I mean, just to tie it back to what we talked about at the top, having that decision-making framework in anything you do in life and in business is really critical. And this is our framework to, kind of eliminate the noise, right? We get hundreds of deals, as you said, sent to us. I mean, just since, January 1st of 2025, we're recording this in mid-January, we've had over 30 properties sent to us. And if we spent equal time on each one of them, we would never buy a deal. So filtering down to make sure we're making a wise choice for our investors, for our residents, and for Faris Capital is critical.
Yeah, well said. Well, thanks for listening in, guys. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.